This is Scott back with the Becker Private Equity and Business Minute podcast. Today's story is First Republic Bank, 6 quick points. First Republic Bank is being pillarized or criticized for so much of its deposits being based on wealthier people. And here's why this matters and what this means. That they had gone after a business of seeking out business from higher net worth clients. This means that a lot of people have money with First Republic that's above the $250,000 FDIC guarantee. Something like 60% of its deposits are essentially guaranteed. This means that it's easier for depositors to move those funds because they're both uninsured, so they're scared to keep them there, and they're highly liquid people that are looking to move that money. So it left First Republic, like it left Silicon Valley Bank, more subject to a run on the bank. For example, if all your depositors are largely in at 250 and not that much more, and most of your deposits are insured, your depositors are less likely to move as quickly because they're not as scared of leaving their money there. If a lot of your depositors are above the $250,000 range, then they're much more likely to want to move when there's a concern about the bank's stability. So that's sort of point one. Second, its paper losses on its loans in the investment portfolio are measured at nearly $9.5 billion to as much as $13.4 billion. So that's a lot of money. Third, it had doubled down the last couple of years on the high net worth business. And this is not a surprise, as so many financial institutions have really pursued the same strategy. This means that a lot of the deposits above $250,000 are not insured, and this means they're more likely to move quickly in times of trouble. Fourth, it had pushed the concept of offering big loans to high net worth individuals. These were done at highly competitive rates, which seemed like a great growth strategy until, of course, the cost of money to them became much higher. So they were lending out money 4, 5, 6% over a long period of time. That all worked fine when they could borrow at the Fed funds rate of 2%, but as the Fed funds rate moved closer to 5%, this became a very challenging strategy. Fifth, its government debt holdings show a current unrealized loss of nearly $5 billion. This is up from an unrealized loss of about $53 million a year ago. This essentially means that the holdings they had, let's say you're holding treasury bonds that are 10-year treasury bonds that were yielding 3%, the current yield goes up to 3.3 or 3.4 or 3.7%. That means the value for holdings, which are yielding a lower amount, go down significantly. In any event, the magnitude of the amount they were holding longer duration bonds means they ultimately are showing a loss currently on paper of about $5 billion from their government investments in bonds. Finally, sixth, the bank stock is down about 90% year to date. And a great article in Reuters about this. See how First Republic's courtship of the wealthy led to meltdown. Now, again, overly criticizing them on the chasing of the wealthy investors is a criticism you could level at almost all of our financial institutions that realize that a huge amount of the wealth is tied up in a small percentage of the population. So everybody's essentially chasing that group, and that doesn't mean that they are wrong. What's wrong is how they manage their investment portfolio. Thank you for listening to the Becker Private Equity and Business Podcast. Thank you very much.